Databricks, $188 billion valuation risk. Will your AI strategy fail? Welcome to this LMPAC Solutions Strategic Business Advisory Explainer. Today, we're jumping right into one of the most absolutely critical intersections of technology and finance in the modern enterprise. So let's just get right to it.
Here's our agenda for today. First up, we've got the $188 billion AI hype. Second, the enterprise data bottleneck. Third, hidden costs and vendor risks. Fourth, we'll walk through the L-Impact Solutions framework. And finally, number 5, securing long-term AI ROI. All right, Section 1, the $1880 billion AI hype and unpacking that massive valuation expansion. We really need to look at this trajectory because, honestly, it's a completely meteoric rise. Back in December of 2024, Databricks was valued at a highly respectable $62 billion. Then, by 2025, it crossed that $100 billion threshold. Early 2026 rolls around and it hits $134 billion. And currently, right on the heels of an estimated $3 billion funding round, it's sitting at a staggering $188 billion. The enterprise AI infrastructure space is just rapidly becoming the most valuable segment in all of technology right now. Institutional capital is literally pouring in, but we really have to stop and ask ourselves why.
Well, the answer lies in the hard numbers backing up that valuation. This isn't just market sentiment or hype. We're looking at an annual revenue run rate of around $5.4 billion, with over $1.7 billion of that directly tied to AI products and services. They've got a customer base of over 20,000 organizations, and they've penetrated more than 60% of the Fortune 500. Institutional capital is validating this $188 billion valuation because Databricks is proving they have massive platform stickiness, meaning, once a company integrates this unified ecosystem, it's incredibly hard to leave. They're successfully shifting corporate budgets away from those isolated one-off AI apps and moving them firmly into these comprehensive data environments. But as a corporate executive, you've got to interpret this valuation as a market signal, definitely not a guarantee of your own success.
Moving right along to Section 2, the enterprise data bottleneck and why strategy fails.
$2.52 trillion. Yeah, trillion with a T. According to Gartner's projections, enterprises are collectively gearing up to commit this astounding amount of capital to AI worldwide by 2026. That is a massive 44% annual growth rate in spending. Organizations are rushing to modernize, essentially throwing trillions at the wall just to see what actually sticks.
But here is the alarming reality check. Right alongside that trillion-dollar spending boom, industry analysts are projecting a 60% failure rate for organizations trying to realize their expected AI value by 2027. The crucial point we need to take away here is this. The vast majority of this capital is at high risk of just being wasted. Throwing money at infrastructure simply does not automatically translate to commercial returns if the foundation itself is fundamentally broken.
So what's causing this disconnect? It really boils down to model capability versus enterprise data maturity. On one side, we have all the shiny objects, the heavy focus on algorithms, procuring large language models, and buying the absolute latest technology. But on the other side, we have the actual foundation, unified cloud environments, consistent metadata, and perfectly clean master data. The principal enterprise bottleneck is not the model capability you purchase, it's the enterprise data maturity you already have in-house. Having hundreds of disconnected apps and fragmented data is literally like putting a Ferrari engine into a car with square wheels. It's going to destroy your AI's reliability long before the model even begins to run a single inference. Governance, not algorithms, is your real bottleneck here.
Okay, Section 3, hidden costs and vendor risks. Uncovering the true price of implementation. History repeatedly shows us that implementation discipline is what actually drives ROI. And the costs? Well, they extend way, way beyond just licensing some software. Below the surface, organizations have to fund an absolute mountain of indirect investments. We're talking massive cloud infrastructure and GPU capacity, incredibly strict cybersecurity and compliance programs, complex identity management, rigorous data engineering, and let's not forget employee training for operational change management. The whole shebang has to be funded and flawlessly executed before your AI produces even a single dollar of measurable commercial value.
And this builds into a much larger strategic issue. As platforms like Databricks expand their ecosystems into unified governments and business intelligence, they become incredibly attractive as a one-stop shop, right? However, this creates severe vendor concentration risk. While a unified platform improves operational efficiency today, it drastically increases your switching costs and contractual dependence tomorrow. Honestly, Unless you're aggressively preserving your interoperability through open standards, portable data models, and multi-cloud strategies, you are basically locking your entire enterprise architecture into a single point of failure.
Which brings us nicely to Section 4, the L Impact Solutions Framework for Building Sustainable Value.
Instead of just indiscriminate technology acquisition, we at L Impact Solutions advise executives to adopt this highly disciplined, four-step phased architecture roadmap. Step 1, you've got to prioritize strict, enterprise-wide data governance first, meaning standardizing metadata and master data across every single business unit. Step 2, migrate your workloads incrementally using hybrid cloud strategies to protect your operational continuity. Step 3, tightly intertwine your AI deployment with zero-trust cybersecurity. Think of zero trust kind of like a highly secure hotel, where your keycard is checked at every single hallway and elevator, not just the front door. AI platforms process your most sensitive IP, so this is completely non-negotiable. And finally, step 4, aggressively develop specialized internal workforce capabilities. Because at the end of the day, cross-functional human capital consistently produces way stronger long-term returns than just buying isolated software.
Now, this is absolutely crucial. Every single AI investment requires predefined financial governance. We categorize this by growth, efficiency, and risk. You need very specific metrics like revenue growth, margin expansion, infrastructure utilization, payback periods, and cyber performance readiness. These aren't just, theoretical goals. They're the exact markers of whether your AI is actually working, and these absolutely must be reviewed quarterly. If you aren't tying these specific metrics directly to your bottom line, you're merely inflating your tech expenditures without ensuring that your capital is actually generating measurable business outcomes.
And finally, Section 5, securing long-term AI ROI and preventing the next failure cycle. I want you to ask yourself honestly right now, are you funding technology adoption or are you funding quantifiable ROI? Future AI leaders are going to allocate their capital through phased funding models. What that means is initial pilot programs have to rigorously validate tangible improvements in things like operating costs, customer experience, and productivity before any enterprise-wide expansion is ever approved. Each stage of funding has got to demonstrate a real, measurable return on invested capital. Ultimately, sustainable competitive advantage over the next decade will not go to the companies that simply go out and buy the biggest AI models. No way. It's going to go to the organizations that successfully convert governed enterprise data into measurable financial performance. So is your AI strategy built on algorithms or governed data? That is the ultimate test of your enterprise resilience. Thank you so much for joining me for this L Impact Solutions Explainer. Keep learning, keep structuring your data. And for more strategic analyses, visit our website link in description below.